Shannon, you made an interesting comment a few moments ago when we were talking about energy stocks, finding it a little bit difficult to be enthusiastic about them here. Listen to what Dubravko Lakos of J.P. Morgan told us yesterday when he was on as to why he is still so bullish.
We as a house estimate that by 2030, you need about $1.2, $1.3 trillion in oil and gas capex for oil and gas demand and supply to balance out. On the supply side, nothing is being done. Nothing. Valuation-wise, the sector hasn't gone up.
Okay. So in other words, don't pay attention to where we are now, even with these huge gains. Focus on the future and the not too distant future of what's still going to be needed and the reason why those stocks are still going to work.
Yeah, I think one of the things that we think about is that we actually don't disagree on the need for more supply. And we do think that the oil market, post, 2023, 2024, after that, we are going to be in an undersupplied situation. There isn't a lot of capex going into these companies. And frankly, it's been good for the owners of these stocks. If you look at Chevron and Exxon in particular, capital allocation has improved significantly for those companies over the last several years. And they're really thinking about, the potential return on projects. And so it has slowed the capex. However, I think in this environment, if we look at what's been leading and what's been running, I just feel that, we have some energy exposure. We're in Valero, we're in EOG. We think that that's the right place to play the energy space. We've got a little bit more beta to the sector in those two names. And so we're trying to get the full move of our equity, of our energy names. I think the thing to think about, though, is it right now to time to add from a cyclical perspective? And again, I just see other opportunities in other sectors, given what energy has already done this year.
Josh, it wasn't that long ago that you added the IEO, and you don't add things all that often, but this was certainly one place that you looked.
Yeah, I actually don't think stock picking in this space matters at all. I think this is a one-way trade, and that one-way trade is predicated on oil and gas prices remaining elevated and U.S. companies continuing to invest less than they ordinarily would have during previous commodity price spikes. So if this were 2005, 2006, they would be fracking and drilling their heads off. They're not doing that, because I think the signal they're getting from Wall Street is keep up the great work, guys, with the profit growth. These are companies that many of which had been profit constrained no matter what the price of crude did for year after year after year. And now all of a sudden they're the belle of the ball. Oil and gas companies have gone from 1% of the S&P 500 all the way up to 5%, which historically is still low. I think there's still room for these stocks to work, and I really don't think it matters that much which one you own at this stage in the game. That will matter later if there's a down cycle, but right now I'm in IEO. Those are the producers. I don't want the large integrators that are hedging. I don't want to screw around with K1s and transmission stuff. I want pure companies that are exploring and selling more and more oil and gas. The more domestic, the better. And that's what I'm getting via that ETF.
Pete, B of A says stay long energy. And you're all over the space, man. All over it. Yeah. Chevron, Kinder Morgan, calls in Chevron, Exxon, Apache, Baker Hughes, Shell, Marathon, Oxy, Southern, Schlumberger. So tell me about your view here then.
Well, my view is that all of these can work, to Josh's point. But I would say this. There are reasons to be in certain names versus other names right now, I think. When you look at some of those big integrated names, there's a lot of different forces that give you a little bit more power with those. But they're going to lag a little bit. And they're going to lag to some of those beta names that you mentioned, a lot of those Occidental and EOG and those kinds of names where you're going to get a lot more bang for your buck. All you've got to do is look at the XOP, which basically has most of those kinds of names, those big beta names, and look at that performance versus an Exxon or versus an XLE or some of the other energy ETFs and stuff. There are names out there that are absolutely on fire. Now, when it turns the other way, those also work in the same direction just as fast onto the downside. So that's the thing you've got to be careful of. I even love a lot of the EV space in terms of battery companies. This ChargePoint has been absolutely on fire lately. A lot of unusual option activity has been in there over the last 3, 4, 5 sessions. And they're just coming in and buying huge sums of calls to the upside. So, there's a reason to be in some of these names. Now, I look at that name and I'm like, look, this can be volatile. And I think that was Josh. it's volatile. We know that. It can go up 7%, down 7%, but the options in there have absolutely give you a lot more flexibility for the upside, and you can withstand some of those pullbacks to the downside too, I think. So I continue to be in the options there, and it's been pretty fruitful so far.